All right, well, thank you everyone for coming this afternoon for us to talk a little bit about the budget and the budget reply for this year. So early this year in March instead of the usual May. So I'll be talking first about the tax and general business measures. So my name's Tom Aitkenhead, one of the directors here at Hoffman Kelly, and then we will have Andre from HKS Financial Planning talking about superannuation measures. If you have any questions on the way through, happy to take them. And then at the end, we welcome you to stick around, ask us any questions you have, and we'll have a drink and some food. Okay, so disclaimer, we do our best to get everything right, but if we don't get it right, that's your problem. Ask us specifically for advice about you before you really go ahead and do anything. So just to sort of talk in general first is what I'll do. Some observations about the budget, then we'll be talking about some of the major measures. So the skills and training deductions that were announced, the technology deductions that are in the budget, the personal tax rates and the increase to the personal tax offset, some other measures about fuel and COVID tests, and then some data measures. Now, these were sort of the main budget measures. There's then one other point that I'd like to talk about, an ATO publication that also came out in February, and it's going to be a big issue in the future called Section 100A. So I'll just give some extra information about that because I think it's a big deal and it's current right now. So in general, the election that's just about to be announced is not being fought on tax issues. There is not a great deal of tax information in this budget. There's not a great deal of tax information from the Labor Party in their reply. I think after the last election that really was fought on tax issues, Labor Party is not keen to do that again. And after all the COVID stimulus spending, there wasn't a lot of money left to really make a lot of other spending measures this time. So it's a definitely restrained budget for an election year. It's kind of more tinkering, trying to achieve a couple of minor objectives, and one of which might be to make people a little bit happier before they have their vote in the coming weeks. From the economic point of view, and the assumptions that underline the budget, unemployment is at the lowest rate for nearly 50 years, so it's only 4%, and it's expected to decrease further. And inflation's at the highest rate that it's been for quite a long time as well, so expected to be 4.25% for the year to 30 June this year, and then to be 3% 2023, 2.75% in 2024. So I guess what that means as well is that we might expect some increasing interest rates sometime in the near future, with of course the RBA always trying to have that rate between 2 and 3%. Okay, one other observation was the depreciation rules. So they have not been extended for immediate claims, which we all thought they might be. So the original measure was that you could essentially, as long as you had a turnover of less than $50 million, you could pretty much purchase a new asset that would normally depreciate but claim 100% of that cost immediately you received it and it was ready for use. So that originally was supposed to run to June 2022. Last year was extended till June 2023. It didn't get mentioned in this budget, so it's not extended any further than that as far as anyone knows. So if you are thinking of ordering something, you've kind of got 15 months from now for the asset to arrive and be in use. And I mean, there could well be some assets with very long lead times that it takes to arrive now. So, some things might take 12 months. So if you are thinking of buying some sort of asset like that and planning on getting the 100% depreciation claim, now might be even time to start looking at that because it may end next June. Okay, so one of the main things that everybody was talking about from the budget was this new measure about skills and training. And in the papers, it's going to be called the Small Business Skills and Training Boost. And what this is that you're going to get a 120% tax deduction for money that you spend on eligible training. So if we spend $10,000 on training, we'll get a $12,000 tax deduction, which is pretty good. You know, when you look at, okay, well, that extra $2,000 tax deduction would save us 25% tax, which would be, you know, $500. Effectively, it means it's reducing our training cost by a 5% amount. So, what's eligible? Who knows? It doesn't say anything. It's about 2 paragraphs, this whole thing in the papers. And what it says is that the training must be external and delivered by providers registered in Australia. So that's the full detail that we can get at the moment. Can't really tell you any more than that as to if you've got some training booked in for next week, whether it will count or not, but it might. And the other criteria that you have to meet is that you must be a small business, so with aggregated turnover less than $50 million. Now, I tried to sort of guess what things might be included, or, you know, what would be eligible. And I sort of did that by looking at the expected cost to the budget. So this runs for 2.25 years because it ends in June 2024 and it started now. And it's expected to cost $550 million in tax, which I calculated means that there needs to be $11 billion spent on training to have that tax cost, which seemed to be a lot over 2.25 years. So I thought it's probably going to be quite wide as to what's included, but who knows? I guess we have to see what actually comes out in the legislated detail. So as I mentioned, it is supposed to have started already. So from the 29th of March, it runs till June 2024. And this is the way that you will claim the deductions. So for the 2022 year, so the year that we're in now up to 30 June, you will just claim the regular training expense in the 2022 tax return. The extra 20% deduction, so if you've spent $10,000, you would claim $10,000 in this year. That extra $2,000 deduction would go in the following year's tax return, the 2023 tax return. Seems silly, like why would that happen? I mean, I don't know, but I'm guessing it's because they don't have enough time to get the tax return labels ready for these extra amounts to go into it. And so that's my guess as to why that bit will be in the following year, because after that, like the 2023 ones and the 2024 ones, you just claim them all in that year that it happens. So even if you do a whole ton of training through, you know, April, May and June now, you're not actually going to get the tax benefit of that extra bonus deduction until you lodge your 2023 tax return, like a full 12 months later. So I wouldn't rush out and do any training right now because you don't know if it's eligible in the first place, and also you won't get that deduction bonus until later. So that's on the training. The other measure that was probably the most widely talked about and sort of new thing, very similar concept, so a 120% tax deduction for technology expenses. So this one was called the Technology Investment Boost. Exactly the same concept. If you spend $10,000, you'll get a $12,000 tax deduction. So it will reduce the cost of your tech by 5%. Now, the detail about this one so far is that it's supposed to support investment in digital items such as cloud computing, cybersecurity, accounting and e-invoicing software, and web page design. Again, you have to be a small business, so turnover less than 50 million, and this one has a cap of $100,000 of expenditure per year. So again, still not clear exactly what is and isn't eligible, but again, it applies now, or it's supposed to apply now from the 29th of March. but this one only goes for 1.25 years, so this one ends June 2023. So it's quite targeted, I guess, to encourage people to spend a lot of money on their tech in the next 15 months. This one was expected to have a bigger cost, so $1 billion in tax saving. This was the estimate, which I calculated meant there was going to be $20 billion of eligible expenses over this next 15 months. So, and with a $100,000 cap per business, I mean, it has to be pretty broad, I think, of what will be eligible and covered. So exactly the same concept as the other one of when you claim the extra 20% deduction. This year's up to 30 June is in the 2023 return, but any 2023 expenses are in that 2023 return as well. So again, I think until you know exactly what it is, I wouldn't be making any major tech spends until that legislation goes through and you can tell if it's eligible or not, on the basis of the extra deduction, of course. So issues with these measures, one, well, will they ever even be legislated? They're supposed to be in effect already, but you could spend money today and then the legislation never gets passed, you're never going to get your bonus deduction. So I would want to see that go through. We don't know what's eligible in the first place, so we'll have to wait and see when they put out the detail which measures are actually covered. It's going to be a bit of a pain in separating, you know, what dates everything actually happened for this year. When you come to do your 2022 tax return and you've got expenses on, you know, computer expenses, we'll have to actually sort through all the dates and see what was after the 29th of March and what was before, which ones are eligible, which ones aren't. So that's going to be just sort of a practical thing to deal with. Yeah, another issue, obviously, you don't get the benefit of it in these 2022 tax returns that will be then done. And also, I'd just like to think about the effect that it has on your franking credit balances and on dividends, and whether these types of bonuses are actually a good idea overall or not. So when I'm talking about franking, if we've got, you know, our accounting records and what happens, and we have income of $500,000, expenses of $250,000, you know, the cash that we'll have left over is a profit of $250,000. But our taxable income is not going to be $250,000. If we've got some of these expenses that are eligible, we're going to get an extra tax deduction. So if we had an extra deduction of $20,000 as that bonus, and we only pay tax on our $230,000, after we pay our tax, you know, that cash we'd have left over is $192,500. Now, this is great if we want to leave all this money in the business, in the company, but there's really no point if we want to take it out. Because if we want to take it out, that's by way of dividend. We pay the dividend, we only get the credits for what we've paid anyway, which is limited to the lower amount. The rest is unfranked, and we just end up paying what we would have in the first place without ever getting the bonus deduction. So it's really not that great usually if you want to take money out of something, but this could be really good in the context of having had reducing tax rates in companies for a number of years. So with the tax rate having gone from 30% to 28.5% to 27.5% to 26%, now to 25%, you actually end up with a lot of trapped franking credits that you can never get out because, you know, you've paid at 30, but now you can only pay them out at 25. If you get some of these bonus deductions, we might be able to sort of unlock some of those extra trapped franking credits and actually use them. So this could be a good measure as well. If anyone ever mentions that you've got all these trapped franking credits that you're never going to get out, this might be a way to sort of make use of some of them as well and actually get that benefit. Next measure was an extremely exciting $420 offset that most people will receive when they lodge their 2022 tax return. So this is the low and middle income earners tax offset, or I call it LMIDO. And it's been in place for a few years, and the amount previously was up to $1,080, and that's been increased just for this year's return up to a maximum of $1,500. So you'll get the maximum $1,500 if you earn between $48,000 and $90,000. You'll get something if you earn $37,000 or less, but are still paying tax, and you get nothing if you're over $126,000. So the policy intention was described as to offset some increases in cost of living expenses of everyone. So it would be sort of quickly delivered to people on these levels of income. And you get it as a sort of lump sum adjustment to your tax refund when you lodge your 2022 tax return. So it can go out, from July, so fairly quickly, and I don't think there's going to be any problem with this measure going through the legislative agenda. Everyone seems to agree that this one is going to go through. Now, this offset ends at June 2022. This is the last year. It's not going to be in any future year. So everyone who's been lodging their returns, sort of getting their $1,000 offset per year, or $1,500 it will be this year. When you lodge your return after that, it's going to go down if everything else is the same. So people who've got used to that sort of excitement of doing their tax return, because then they get a refund, can enjoy 2022 as that last year of excitement. And I don't think it's going to get extended, just my own personal guess, because it's super expensive to have this measure. So it costs $7 billion for 1 year to have this measure. And I think that's what's paying for a large part of the personal tax rate cuts that come in 1 July 2024. So those are big cuts. They're already legislated. Everyone says they're not going to repeal them. Like, both sides say that they're not going to take them away. So I think if that Lamito comes back in, these would be pretty unaffordable. So it seems like these tax rate decreases in the 2025 year are still going to come in. And that's a pretty big saving for people really who have the highest incomes. So if you have income of $200,000 or over, that's where you get the biggest tax saving when these cuts come in July 2024. Other measures. There was a fuel excise cut. So this is also intended to sort of very quickly decrease some cost of living pressures. It's only for 6 months, and it will end on the 28th of September of this year. So the fuel excise rate is going to decrease from 44 cents a litre to 22 cents a litre for that 6 months. So what that means is fuel should be 22 cents a litre cheaper for the next 6 months than it otherwise would be. And it's expected to cost $5.6 billion to pay for this decrease. So that's an expensive measure as well. And that's going to flow through, I guess, to everybody who buys any type of fuel. I didn't really know a lot about fuel excise or what it was, so I kind of did a little bit of looking into the history of it. I mean, excise just means tax, just fuel tax. So it's a flat tax on every litre of fuel that's purchased, and it's 44 cents at that normal rate. Contributes about 4% of the federal government's total revenue, so it's a big money earner for them. And there seems to be some sort of theoretical alignment in what they do, in what they collect on that, and how they fund roads. So the design of it originally, I believe, is that it was supposed to be users of the road pay for that road. The way that you would work out who was using it is by, they were having their fuel purchase, and that was obviously who was using the road. And so that's how the concept was introduced of this fuel tax. I just don't see how it works like as a long-term thing. It's definitely that structure of this tax is going to have to change in some way. because, yeah, if you have an electric vehicle currently, you're paying nothing towards this use of the collection of this money. And if that proportion just keeps going up, well, how are the roads going to be funded? So there's going to have to be some alternative funding mechanism for it. I wonder what that will be. I read a few papers about options discussed, sort of duties on the extra purchase of a car. They're sort of flat and don't, go up or down with use. Rego of car, because that already contributes to the state government's funding of roads. Yeah, I just thought it was an interesting topic of how we're going to fund this in future. COVID test deductions. So, this was the most urgent legislation of the past 12 months, apparently. When on the 2nd of January, Scott Morrison was on Sunrise and announced that a particular person was going to get a tax deduction for the COVID test they had to buy to go to work. And everyone went, no, they're not. That's just not right, and those things won't be deductible. They rushed through some legislation to make it deductible in February. So that legislation goes all the way back to 1 July, so that employees can get a tax deduction for COVID tests that they've had to pay for, or for employers to get a deduction for tests they've had to pay for their employees in the last year, as long as it was work-related. I don't know how many people will have been keeping receipts for all these things. I think, for most of the time anyway, they were free up until at least December. There are a lot of data measures in the reports. I find these usually kind of interesting just from an idea of, well, what are they getting? What are the revenue authorities getting? What does that mean? What does it seem like they're going to be focusing on in the future? Because there's just this huge general trend of trying to collect more information, match the data, and have electronic reporting of everything. So there were 3 things that I picked out of the papers this time. One was about digitalising trust reporting. So all the income of every trust that's gone to any beneficiary that is supposed to be electronically reportable by July 2024. So the funding for it is working with a lot of software providers and the ATO to make sure that can happen, which will then, it has the goal of simplifying the tax affairs of beneficiaries by it being reported, but also it will make sure that people must report that income because it's being reported to them electronically. And the other measure similar to that was about single touch payroll data is being funded so that wage and super information can be shared with the state revenue authorities and perhaps even pre-fill payroll tax returns. Now, payroll tax is a super underpaid tax. So this, if that data goes directly from doing your payroll to the state revenue authorities, there'll be a lot of extra revenue raised there. And it also makes me think that everyone should check their payroll tax obligations now to make sure that if they do need to be paying this, they're not going to have a big problem that goes back many, many years at the time when the ATO reports it to the Office of State Revenue and they realise you should have been paying tax for a lot longer. The last measure that I noted was the ATO's tax avoidance task force has got extended, so $650 million of extra funding there. So instead of that task force that was only funded to June 2023, it's now funded to June 2025, which means we can all expect sort of more contact from the ATO to make sure that everybody's doing everything properly. Now, that task force started really in 2016, and it's raised something like $20 billion already in extra revenue is what they claim per this slide. The private groups is what really concerns us, and we have been part of some of these reviews. So the current project they have is called Next 5000. So the first project they did with private groups was they looked at the biggest top 500 taxpayer groups, and they examine every single one of them, and then raise extra assessments or say, no, we believe that you're doing everything properly. So they did that, then they expanded to the next 5,000 biggest groups. So that's what we have coming through now. I think we had one matter with one of the other directors finalised last week, their next 5,000 review. That was super positive. They just gave the big green tick on all the matters, but that was an interesting exercise of what they wanted to see, the governance that they expected from really a private group to be run more like a public multinational thing. So potentially after they finish this 5,000, they might do the next 5,000 from that. You can probably expect to be in that top 5,000 if you have net assets over $50 million. So it's quite a large amount still at the moment, but if it goes down from that, there'll be a lot more people having all of their systems analysed. Okay, so that was sort of the budget measures. The last thing that I just wanted to talk about before I hand over to Andre was the ATO's publications in February that came out about a particular section called Section 100A. This affects pretty much every trust that is a discretionary trust, and the section is about reimbursement agreements. So if you have a trust that makes a distribution to somebody, but somebody else gets that money, and there's an agreement to sort of, for whoever's been taxed on it to give that money to this other person who's actually got the money, that's what the section is aimed at. And the section's been around for a long time, like more than 40 years. It's only ever been used in a couple of cases, and the cases were super egregious. Like one case was somebody who distributed the exact tax-free threshold amount of like $400 to 60 different relatives who all lived overseas. He went over, gave them that money, they gave it all straight back to him, and they flew back to Australia. And this was also like 30 years ago. So that was clearly a tax avoidance problem, but these ones are talking about things that are super common now. So, within a family, distributing to a child, and that child, maybe hasn't received all of that cash. This is what it's targeting. So there's an exception to the section being able to apply, which is for ordinary family dealings. And in the publications the ATO has just put out, they believe that nothing is an ordinary family dealing. So they have put these things out. What does it mean? It means that's what they think. It doesn't mean it's the actual law, because what is an ordinary family dealing? I mean, Parliament could clarify that, or there could be cases, but the ATO said they think that there's basically nothing that is an ordinary family dealing. So the response from the professional bodies that will go into these drafts is going to be super negative about what the ATO has done. The response from the profession is super negative and angry, that everybody thinks this is completely wrong. Hopefully there will be a response from the government to actually clarify what everything is. And hopefully there'll be some more cases to clarify how this section works. There was a case that finished in December last year. The ATO lost it badly, and then those publications they put out were the exact opposite of what happened in the case. So we will have to deal with that when we're looking at tax planning for this 2022 year, but I guess we just have to deal with what they've done. Yeah. So that is the end of the section on the budget that I wanted to talk about. So we'll just take a quick break and then we'll hand over to Andre. If anyone has any questions, I'll take them now though, on these parts. Does anyone have anything? No?
So if I'm a business owner and I'm using the skills boost and I provide training to my staff myself internally, do you think that's going to be covered by the boost?
No, it definitely. So the question was, if I provide training to my staff internally, is this going to be eligible for the 20% extra tax deduction boost? No, we definitely know that's not going to be covered. It has to be external training.
Tom, don't know if you know, but just for the cut in fuel excise tax, what will be the implications for people for claiming fuel tax offset?
So the question was, if you are claiming fuel tax credits, how does the cut in the fuel excise impact on that? I have no idea. That's a good question. Yeah.
I think it will just reduce your return because you're spending less.
Well, yeah. I mean, the total spend is less, so that's got it.
They release the rates every time. They might change the rates.
Yeah.
Thanks, Tom.
Oh, you answered your own question. I didn't do anything. Yeah. Okay. Well, we might just switch over for Andre now.
Thanks, Tom. So I'm Andre from HKS Financial Planning. I'm a financial planner down there. Today we're going to be talking about the federal budget for 22-23. Like Tom mentioned, there wasn't really too much from this budget. So we're going to have a focus as well on last year's budget because there's a lot of issues and strategies that came out of the last budget that actually come into effect on 1 July. Like Tom also said, the disclaimer, this doesn't take into consideration your personal circumstances. Give your financial planner at HKS Financial Planning a call and we'll be able to go through your personal circumstances and apply strategies. Perfect. So today we'll go through quickly the proposed superannuation changes from the current budget. Then we're going to go have a look at the 2021 budget updates coming into effect. So there's a few changes. So the amendment of the work test, that's a big one. The bring forward rule, recontribution strategies, a downsizer contribution strategy, and then also first home buyers with prices and properties skyrocketing. They've introduced some schemes to try and make them more affordable. So firstly, the proposed superannuation changes. The first proposed superannuation change was the reduction of minimum drawdown rates. So they brought this in initially as part of a COVID-19 response. So when COVID-19 first sort of hit, markets reacted negatively, significantly. So when they fell, if you had to draw 4 or 5%, double these amounts of your superannuation balance, and at that time markets were down, you would be selling assets at a massive discount. What came into effect after that was that also interest rates fell. So people were drawing large amounts, sitting them in cash. That cash hasn't been doing anything for years. So pensioners are using those funds. And so if we move money out of superannuation and into their bank accounts, it's not doing anything anyway. So there's no loss in taxes for the government. Social Security, this is a big boost for pensioners who are struggling at the moment. So there'll be a one-off $250 cash boost in April this year to basically everybody that receives some sort of age pension, support pension, care allowance, everything below there. And that's it. There wasn't too much from the current budget. So what we're going to look at is how we can look at 1 July changes and how they could affect you. So a big change is the removal of you needing to earn $450 to receive superannuation guarantee payments. What that means is people on low incomes, if they had casual jobs or multiple jobs, they might earn $400 at one job and $400 at another job and not receive superannuation contributions at all. So those people will now receive superannuation contributions. Another one that we've seen a lot recently with rising house prices is the reducing the eligibility age for downsizer contributions. So you used to have to be 65. Now, if you're over 60 years of age, you can do downsized contributions. We'll go through that one in more detail. Another change is the maximum amount of voluntary contributions that you can release to buy your first home. So that increases from 30,000 to 50,000. We'll go through that one in more detail as well. There's no announcement on this one, but initially they did announce a increase of the superannuation guarantee payment from 9.5% to 12% over a few years. And this year we're expecting it to rise to 10.5%. So those contributions will go up. The next one, which is a big change, is the removal of the work test for people aged 67 to 74 for most contributions. We'll go through that one in more detail as well. And then also as part of that, the eligibility to use the bring forward rule. So the amendment of the work test. What the work test is that it says that you have to work 40 hours in any 30-day period if you're aged 67 to 74 to make a contribution to super. So those contributions are your non-concessional, so your contributions after tax, salary sacrifice, and then contributions which you try and claim a tax deduction on. So that's been scrapped for everything, but it still applies to claiming a tax deduction. So people that would normally use that is if you're over 67, say you sell an investment property that you've owned for the last 20 years, you've got a massive capital gain, and to reduce that capital gain, you try and claim a tax deduction by putting money into super. For that scenario, you would have to claim a tax deduction. You'd need to prove the work test. All other contributions still apply. Once you hit 75 though, you can't make any contributions in terms of salary sacrifice or voluntary non-concessional contributions, but you can still do downsizer, and if you're still working, you can also have your superannuation guarantee contributions as well. So the bring forward rule. So what this is that we have non-concessional contributions, and what they are is they're not concessionally taxed. You don't get a tax deduction for making a contribution to super. You can make $110,000 in any 1 year. If you make additional contributions above that $110,000, even $1, you'll trigger the bring forward rule. So the bring forward rule allows you to use not just next year's, but the year after. So instead of making 110, you can do up to $330,000 in contributions. There's a few changes to that, a few restrictions on that. So as this table below says, your balance has to be below $1.48 million. If it's above that, but you're below 1.59, you can do 2 years or $220,000. And if you're getting close to that 1.7 million, you can do 1 year. And if you're above 1.7 million, you're going pretty well. So you don't need to put any more money into super. The other big thing on this, the age restriction. So you only have to be 74 for any 1 day in the financial year to make the contribution. All right, so an example of this, we've got Mr. Burns here. Mr. Burns is 68 years old, surprisingly, and he has a total super balance of $1.1 million. So if we look back, we've got the 1.48 million, so he's below that, so he can do 3 years of contributions. Mr. Burns, he receives an inheritance of $450,000. So he's got a couple of strategies that he can do. So Mr. Burns, he knows the rules, and he goes and he puts $330,000 into his superannuation fund, triggering the bring forward rule, but he's got 330 in. Great job. What Mr. Burns then decides to do is he goes and talks to his financial planner first. We could initially put $110,000 in today, then wait till the 1st of July. Because we haven't triggered that bring forward rule, we could put another $330,000 in, and then you get 440 in, and you've used most of the inheritance. You won't be able to make concessional contributions until, non-concessional contributions, until 1 July 2026. But what it does mean is that you've got most of that inheritance into superannuation. And the reason you'd want to do that is because at 68, he could draw the money from a pension account, and that would allow him to have any income or earnings tax-free. So it's a great way of investing for retirement. So strategy implications. There's lots of contribution opportunities, as we just saw. There's an extra 8 years of contributions by stretching out and getting rid of that work test. The potential to access the bring forward rule, you could do that at 67, then 3 years later, and keep doing it right up until you're 74. So the only caveat on that is that you wouldn't want to get close to the maximum total superannuation balance. Other opportunities is access and recontribution. So with unrestricted access to super at age 65, we can restructure superannuation, equalise balances. So if you have a couple, one partner's predominantly worked on a higher wage, and you've got another one who hasn't worked as much or worked on a lower salary, their superannuation balances might be out. So you might have one member of the couple who's close to your total superannuation balance. So by evening them out, you can get more money into super, which maximises the amount that you can invest tax-free. Another good strategy that we've seen lots now is also a recontribution strategy, which reduces tax paid to your estate. So what is a recontribution strategy? Pretty simple. A recontribution strategy is withdrawing your money and recontributing it to super. But why would you do it? So superannuation benefits, they're either made up of a taxable component or a tax-free component. The tax-free component, or taxable, is determined by how you make contributions to super. So if you receive a concessional contribution or you're concessionally taxed, it reduces the amount you pay tax on, but you could potentially pay tax if you were to pass away. The tax-free is those non-concessional contributions where you're not getting a tax deduction. If we look down here, the biggest beneficiaries of this is non-tax dependents or children over 18 years of age. So if you're a spouse, child under 18, or somebody who's dependent on you financially, upon passing away, if you paid your superannuation balance to them, they won't pay any tax. If you're non-tax dependent, somebody over 18, if the taxable component is there, you'll pay tax up to 17%. Whether you pay tax at 17% or 15% depends on how you nominate them. So if it goes directly to the person or the adult child, they'll pay 17% tax through Medicare. If you go to your financial planner, distribute it through the estate, you will avoid the Medicare tax. So, a recontribution strategy. Here's Abe, he's 65. He's looking a bit worse for wear as well. He has $400,000 in his superannuation funds. $200,000 of it is tax-free. Conveniently, $200,000 is taxable. As Abe is 65, he's met a conditional release, so he can keep on working and still access his superannuation balance. His total superannuation balance at 30 June last year was less than $1.48 million, which means he can recontribute funds back into superannuation. We talked before about the non-concessional contributions and the bring forward rule. So if he withdrew $330,000, he could use that strategy to put it back into superannuation. The thing that we see a lot is that people see that $200,000 taxable component and they say, hey, can we just take that money out of super? Which you can't do. So however it's broken up is how the money is proportionally withdrawn from super. So with Abe, we take the $330,000 out of his super. So his initial superannuation balance is $400,000, split 50-50 each way, so it's $200,000 each. We withdrew $330,000, which is the $165,000 from each component. Then we put back $330,000 into super, which all forms part of his tax-free component. So now when we look at it, Abe, he has $365,000 in a tax-free component and $35,000 in the taxable component. So if we look back up top, he originally had 50% taxable, now 91.25% is tax-free. So what does that mean? Tax payable before the strategy was implemented was roughly $34,000, assuming he went to his financial planner and had his beneficiaries nominated correctly. After the recontribution strategy, the tax on the $35,000 is $5,950. So you saved the whole $28,000 purely on completing some forms and redistributing how the superannuation is done. So another strategy we use is the downsizer contribution strategy. So we've expanded the eligibility on downsizer contributions. What it means is previously, or right now, you have to be 65 years older. From 1 July, if you're over 60, you can make the contribution. So what does it provide? So it's a one-off after-tax contribution of $300,000 from the proceeds of selling your family home. You have to have held it for at least 10 years. Under the rules, if you're a couple and you own it, you both can make contributions of the total $300,000, and it doesn't count towards your non-concessional contribution cap. It's also able to be used after age 75. So there's no cap on you or worrying about non-concessional contributions. It's a great way if you're selling a house and want to downsize, as the name suggests. Some considerations. So the contribution will be counted towards your total super balance at the end of the financial year. The big one is contributions must be made within 90 days of settlement. So if you sell a house and then you've got a lot going on, you need to make sure that you've probably already spoken to somebody before you settle so that these plans can be put in place. And you must have owned the main residence for a period of 10 or more years. So another example, we've got Homer and Marge. They look pretty good for 69. They own their home jointly and have lived in it for 25 years. They sell their home on the 1st of August 2022 for $1.26 million and then move into their investment property up the coast for their retirement. So what they can do under a downsizer contribution measure is within 90 days, Marge, she makes a $300,000 contribution, while Homer, he also does it. He does $300,000 as well. So they've got $600,000 into super. They're both eligible to make one, so that's all fine. But also, both their superannuation balances are below 1.48 million. So what they can also do is use that bring forward rule that we spoke about earlier and get another $330,000 into their super as well. So effectively, they can use all that money, get into superannuation, and have a tax-effective retirement. Finally, a strategy for the younger people in the room as the First Home Super Saver Scheme. So this was initially brought out to help with the affordability of housing and with people struggling to get in. So since 1 July 2018, you can make voluntary contributions and access those funds for your first home deposit. The funds, they are, to make it easier and not have to worry about market movements, no matter what the super fund does, they're deemed earnings at 3%. So you get that 3% no matter what. But the funds that you put into superannuation, you have to use to purchase a home and you have to live in the home. You also have 12 months from when you access the funds from the superannuation fund to purchase property. You can apply for an extension to 24 months as well. So the maximum threshold was $30,000. That's now increasing to $50,000. It's a really, in terms of opportunities, it's basically a great way to reduce your tax by making contributions to super. One of the considerations though is that you pay your marginal tax rate less 30% when it comes out. So for most people, that's going to reduce a lot of the tax, basically everybody. And it just allows you to make that saving. What you have to be aware of is that you can only put $15,000 in per year. So you can't go, hey, I've got a little money off mum and dad, let's put it all into super, reduce my tax to 0 this year, and then pull it back out and buy a house. You have to gradually save money for a house. Big one is submit your deduction notices. So people like to put money into super, then forget about it and don't submit the deduction notice, then you don't get a tax rebate. You must request a determination before the contract. So you log into MyGov and you submit a determination, pretty simple, and then they'll release the money to you prior to the contract being signed. and you either have to do it 14 days before or 12 months after you request the release. So we've got Ned here. Ned here earns $100,000 a year, and he wants to save $200 a week for his first home deposit. So we've got two scenarios. Ned's just saving into his bank account, $200 a week. He's paying his marginal tax rate. Net savings, you got $6,812. So Ned's going all right. But if Ned goes talks to his financial planner and does it through superannuation, that goes from the tax saving, takes it to $8,840. So it's a simple way to increase those savings for your first home by $2,000. As I mentioned before, Ned will receive his marginal tax rate with a 30% offset, and that these savings have to be used to purchase a home. This can be used with the home guarantee scheme. So the home guarantee scheme, what it allows you basically to do is to buy a house with a smaller deposit and not pay lender's mortgage insurance. So there's 35,000 spots you apply for them for first home guarantee, which, as I just said, allows you to buy it with a small deposit. But they also introduced a regional home guarantee. So this supports people, not just first home buyers, to buy houses in regional Australia. And then they've got the family home guarantee. So this allows single parents with children to either buy their first home or re-enter the housing market, and they just need a 2% deposit. There is caps depending on your suburb, so you just have to enter what suburb you're looking to buy in, and they'll tell you the maximum property price. So in summary, as Tom mentioned, 2022 budget didn't have too many changes, but the 2021 budget is where we're seeing already lots of changes, and lots of clients are coming to us to maximise those strategies. We're working really closely with Hoffman Kelly to make sure clients on both sides of the business manage to use their superannuation in an effective manner. If you have any questions, feel free to ask now, or else you can contact us directly or speak to your accountant. That's our contact number, website and email. Any questions? Okay.
So with the first home super saver scheme,
Yep.
can you do that if you're a member of a couple, or is it just a single person?
Yeah, so you can both do it if you're a member of a couple, and then you can both use it for the same property.
So you could have 100,000
Yeah,
between a couple.
yeah.
Wow.
But you both have to be first home owners.
So if one's a member of if one's already bought a house and one hasn't?
Then only the person that hasn't bought a house can do it.
Okay.
Are you
Yeah.
saying those spots at any suburb, or are they like specific areas that the government's targeted?
No, they're not specific areas. They're anywhere, but they're like, because house prices are different in Sydney to Darwin, they change the cap on it depending on what the suburb is. So you just plug in the suburb that you're looking to buy in, and then it'll tell you what the maximum is. And they should be changing each year. So they haven't quite released the 2022 amounts, but hopefully they go up. Cool.
That's 35,000 spots national.
Yeah. So how you do it? Speak to your mortgage broker, but you apply for a spot with the lender prior, and then at 1 July they basically all come in, and it's first in, first served.
So you can't apply after 1 July?
You can, but like last year they all. You
If you apply in September, what happens?
oh, you can still do it, but like last year at 1 July they ran out really quickly because everybody wanted them.
Oh,
So there was only 10,000 spots last year, so that's why they're increasing them. So you just got to get in quick.